Oil prices caused the M&A market to slow down last year. This year, we think they'll have the opposite effect. In 2015, uncertainty over oil prices left buyers and sellers unable to agree on deal pricing. But after 14 months of intransigence, doing nothing is becoming less of an option. If prices stay low, more companies will become financially stretched. Asset sales will become a necessity. Consolidation will increase. If prices recover, more buyers will come into the market as strategies switch from survival to growth. Extreme volatility is a wild card. Short, sharp directional changes can rattle sentiment and scuttle agreements. But increasingly, that's a factor which will have to be dealt with as a tide of distress sweeps the industry. Last year began with oil prices in free fall. The M&A market was paralysed by uncertainty. Q1 was one of the worst quarters on record. As prices stabilised and recovered through Q2, an emerging consensus on long-term pricing strength began to drive a recovery. Shell announced its record-breaking bid for BG, and the market began to pop. But when oil prices took another leg down, the M&A market's resurgence slowed. The gap between buyers and sellers widened again. At the end of the year, some sellers began to lower prices for non-core and particularly high capex assets. But the rejection of 4 large corporate takeover bids showed that it was by no means a true buyer's market yet. 3 weeks into 2016 and the gloom around oil prices has worsened. It's bad news for the industry, but we expect it will drive higher levels of M&A activity this year. We're going to see more sellers. Mounting distress will force more companies to market as balance sheets become more stretched and financing options more limited. There's diminished scope for the type of cost-cutting, project deferrals and dividend cuts that we saw last year. That means some companies will have to sell assets, whether they like the price or not. There will always be counter-cyclical buyers, whether that's NOCs and IOCs looking towards long-term strategic deals, private equity looking for mid-term turnarounds, or ambitious small caps looking to capitalise on the weakness of their peers. If the price is right, there will be demand. We'll also see more consolidation, deals focused on cost-cutting and operational synergies, maybe leveraging expertise and technology. After more than a year of battered share prices, simply regaining critical mass will be a driver for some. So what does this mean for valuations? Well, we're going to see continued divergence in deal valuations. Prices for higher quality assets will soften, but we don't expect an immediate collapse. There will still be interest and competition for the best assets. Poorer quality assets, however, will increasingly be sold at much lower prices which buyers are expecting to pay. Sellers will also have to be realistic about the weak market for capital-intensive and pre-production assets. But keep an eye out for deals which are structured to ease the pain. Expect more swap and share-based deals. Look for the less common arrangements like contingent considerations and vendor financing. The world is awash with oil right now, but this position will not last forever. Wood Mackenzie sees a tightening in the market later this year which should begin to firm up prices. As we saw in the middle of last year, when sentiment takes hold that oil prices are on the path to recovery, M&A activity can pick up quickly. First mover advantage is key, securing deals before competition grows and inflation sets in. At the moment, companies are focused on survival, but this could quickly shift back to growth in a recovering oil price environment.